Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin using logarithmic regression. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Remember, we also do have a free tier available, which will get you access to a weekly newsletter, as well as a few charts on the website. So make sure you check that out. It is free to sign up for that one. Let's go ahead and jump in. So it's been a while since we did this video on logarithmic regression using the logarithmic regression rainbow, but I thought because of where we are in the cycle, this would be a timely point to sort of provide an update on the logarithmic regression model. Now, what's interesting is we've talked about this model for 4 years now. 4 years now. And we've used it to identify secondary scares and where they bottomed, but also where you might find peaks in a bull run. Okay, and we're going to go through each and every one of those. So let's first look at the lows, look at what we've seen so far, project out what that would mean if it were to follow that pattern. Once we've done that, then we'll look at the highs. All right. So let's start after the first peak. What do you notice? We had a low here, right? And at this sort of regression band up here, this light green one, but eventually we went to a lower regression band and sort of rode that one up in the bull market, right? So you have a low at one regression band, and then you have a higher low, but at a lower regression band. Now, how can that be? How can we go to a lower regression band even though the price is putting in a higher low? Well, remember, logarithmic regression assumes that the more exponential gains occur earlier in that asset's history, right? So like the earlier the asset is, the more likely it can experience those exponential gains. The further you get out, it's harder and harder to move the price because the market cap is so much greater. So you have a low that's sort of set at one regression band, and then you have a higher low, but a lower regression band. Now keep that in mind because you're going to see this pattern emerge every single time. Next cycle, what happened? The first low, so you have your bear market year, right? And it occurred at this regression band, which, by the way, was the same this was the low of the cycle, right? Right here. We had a double bottom, but this was the low of the cycle. The same regression band that we were moving off of back over here. That was the lowest regression band we hit. That's where this bottom occurred. But then we eventually found support on a regression band lower than that going into the next sustained bull market, right? So in 2015, you get your pre-halving year pump, which, by the way, is not that dissimilar from what we've seen this cycle. I mean, about 100% move to the upside. I know everyone thinks that it's not sideways, but everyone looks at 2015 and calls it sideways, even though you had a 2x rally in here. The only reason it looks sideways is because of what came after it. But if you were living through it, it might not have felt sideways at the time, but 100% rallies and 50% drops should be considered sideways for an asset that goes up 100x at some point, right? So in this case, you have the same thing that happened, right? The low, the first low, occurred at the same regression band that the last bull market was built out from, right? That regression band. But then we had another low in the secondary scare that came later on, right? The secondary scare that occurred at the regression band below it. So you have your bear market year. You then get your secondary scare, which occurs at the lower regression band, right here. And what do you notice? You drop one regression band from this cycle, from the lowest regression band we hit this cycle to the next cycle, you drop one regression band. Do you see the pattern? Low, secondary scare at a lower regression band. In this case, it was a higher low. In this case, it was a double bottom. Go to the next cycle. Where did the low occur? In 2018. It occurred at the same regression band that this bull market was built out of. But in the secondary scare, we went to a lower regression band. You see? It's the same pattern. It's the same pattern again. You get one low, and then you get your typical pre-halving year pump. Everyone calls for new highs. The new highs don't come. We then sell off into the end of the year. We got a recession. A higher low in price, right? A higher low in price, but a lower regression band from where the bull market that took us to new highs was built from. The reason that this was a higher low and this was double bottom, two reasons. First of all, in this case, the main reason, I guess I should say, the main reason is that this occurred much further out in time. This one occurred in Q3 2015, right? So if the secondary scare last cycle had occurred in, say, August of 2019, then it would have corresponded to a price lower than $3,000, right? It's just that the secondary scare was not over until Q1 of the halving year. And by that point, the lower regression band below this one was at a higher price than where that bottom was. Do you see the pattern, right? Do you see the pattern? A low and then a secondary scare, a low and then a secondary scare, a low and then a secondary scare. But every secondary scare took us down a regression band. Okay, every one. It took us down a regression band. In two of the cases, it was a higher low, and in one of the cases, it was a double bottom. If the secondary scare in 2015 had occurred in, say, December, then it would have also been a higher low, right? But it occurred earlier on, therefore it was a double bottom. So you should be able to see the pattern here. So let's project it for this cycle. What happened? Where did the low occur that we've seen so far? The same regression band that this bull market was built from. Is the pattern not the same? This model, by the way, we've had for 4 years. It's not like I didn't just code this up, yesterday just to fit it. We've talked about this model back in 2019, right? So you can see that this low here was where this bull market was built from. But if we stay the course of prior cycle behavior, then it means the secondary scare will take us to the next regression band down. Okay? That's what it means. Again, will it happen? I have no idea. But if the pattern continues, that is what it would mean. So then where is that price currently? Right? That is what the question you should ask. Like, what does the price correspond to right now if we were to have the secondary scare finalized now? So let's suppose that the secondary scare is not over, because I don't think it is. Let's suppose that we still see it, Bitcoin price fade into the end of the year, maybe even into early the halving year, although I think we should be ready for it at any time. Where is that price? Well, if you were to draw a horizontal line across from where this prior low was, you can see that the price corresponding to that lower regression band, which we've always hit in every prior secondary scare, is actually currently lower than the price we hit back in November of 2022. But not by much. Not by much. In fact, it's currently sitting at around 13.8K. Just below $14,000. That's curious, don't you think? One of the reasons that's curious is because that corresponds to the 2019 high, in fact. So, what I would put forth is the idea that if the secondary scare were to occur in the next few months, then it could easily correspond to a lower low if this pattern were to continue. If the secondary scare, on the other hand, did not occur until, say, March of the halving year, then like last cycle, it might be more likely to correspond to a higher low. It all depends on when it occurs, right? When. And I don't know the answer to that question, unfortunately. In 2015, it would have already occurred. It occurred in August, right? Last cycle, it didn't occur until March of the halving year. Right now, we're in September of the pre-halving year. Right now, it would correspond to a lower low. Well, you might say, well, Ben, that doesn't make sense. In 2015, it didn't correspond to a lower low, even though it occurred in August. You're right, but remember, this is a logarithmic regression model. The longer we go out in time, the more this slowly curves over, right? You can see how it curves over as you go further out in time. So the returns diminish, right? We get diminishing returns from one cycle to another. So that is why I say the secondary scare, I think, is still ongoing. I do not think it's over. And I think it will terminate after, or, at some point, whenever we get the resolution of the yield curve. I think that's where it terminates, the secondary scare. Somewhere around there, plus or minus a couple months. And that could mark the end of the secondary scare, right, wherever the lower regression band is. Now, if it occurs in a few months, then it would be different, right, than a lower low. Let's look at it over here because I actually have it drawn out. This is on the website, right? So you can see now that lower level, right? If you look at some of these lower bands, right, it's in that 13 to 14K region, right? So like the first band here is right around that 13 to 14K region, which right now would correspond to a lower low, right? But if you were to say take this out until the end of the year, it would more so correspond to a double bottom, right? So a lot of it, of course, depends on when it occurs. And again, you could have something like 2015 where it even wicks below that one, right? So like this one dropped a regression band, but it even wicked below that as well, just a very brief wick, which could take you a little bit further down as well. So that's something you have to be aware of as a potential outcome too. But I just want to point out, because we've talked a lot about the secondary scare and sort of the nature of the secondary scare, and history shows us that the secondary scare terminates whenever we hit the lower regression band from wherever the first one bottomed out, right? So this one bottomed out around here. Secondary scare took us down another regression band, right? Took us down. This one bottomed out here. Secondary scare took us down a regression band. This one bottomed out here. Secondary scare took us down a regression band. This one bottomed out here. Theoretically, secondary scare takes you down a regression band. Okay? That's why I've said before, some people ask me, well, like, what's your worst case scenario? I mean, like, look, worst case scenario, you could always make a reason that it goes lower. But, I mean, a 13 to 14K would also correspond to the 2019 high. I have to imagine there's going to be a significant amount of support at that level if we were to hit it. Now, if time goes on and the months pass us by, and we're out in, say, February or March of 2024, and we're still, just kind of hanging out around 20K or something, then perhaps the likelihood of it just simply being a higher low becomes more likely. Because again, these trend lines just keep slowly going higher, right? A lot of people discount these models because, they'll just say, oh, well, you can draw another line. But anyone who looks at these patterns can tell that every cycle we drop down a regression band. Every single cycle we drop down a regression band. So we should expect, in my opinion, that there's a chance here that we could drop down a regression band again, right? Why not? It happened every other time. It just depends on when it happens. Okay, does it occur next month? Does it occur, this month? Does it occur tomorrow? Is it sometime in January or February? Who knows? I don't know. But you should be prepared for these outcomes. What's interesting is that you can also use this same analysis to sort of project out peaks. And we actually talked about this. If you were to go back and watch the videos on this from 2019 and early 2020, we talked about how every cycle we drop 2.5 log lines from peak to peak, right? So if this one topped out at this upper red regression band here, you go down 1, 2, 2.5, it puts you right here. 2.5 log lines down was this peak. Then 2.5 from there, half, 1, 2, puts you down at this one, right? This yellow line right here. 2.5 log lines down. And so we speculated that the next peak could occur 2.5 log lines down. But then when April came of 2021, this was where all the risk level, the risk metric models that I have were screaming, this was the highest risk band. So, I sold back then, I actually sold most of my Bitcoin into that rally. Now I accumulated more here, and I thought we would go up a little bit higher over here, right? It did, but we didn't. And, a couple months later, I was like, well, we gave it our best shot, but it's time for us to go into the typical bear market year and say, you know what? I mean, this is historically, what happens, right? We talked about the 200-day SMA acting as resistance, into this rally over here and how we'd likely get rejected and go down. But what's interesting is that while we only dropped 2 log lines from here to here, right? 2 log lines, it was 2.5 if you look at the 69K peak. The 2.5 log line rule still occurred. We actually went up to the 2 log lines down initially, and then we topped out later 2.5, which is interesting. 2.5 log lines down from there, so half, 1, 2 puts you at this one, which is currently at around 42K. So that basically would say, like, if the peak were to occur tomorrow of the next cycle, then this rule, the 2.5 log line rule, would basically say, all right, well, 42K is the level. But again, this is going to move higher as the years go on, right? So like if you were to project this out all the way out, say 2024, 2025, obviously those numbers are going to slightly go up, right? So like by, if you were to sort of just zoom in here, so that level right now, while it's at like 42K, by let's say February 2024, that level would be at 53K. Okay, I don't think Bitcoin's going to be at 53K by February 2024, but that's just where it would be, the 2.5 log line rule down. I mean, a lot of times it's worthwhile to sort of look at where it might go out into, say, 2025, or sometime around that level. And if it were 2025 and you were looking at this same line, it would correspond to, let's see, so this would be November 2025. So it actually correspond to right around 100K. So I mean, a lot of it depends on when it occurs, and we don't know when. No one knows exactly when it's going to occur. There has been some seasonality about Q4 of the post-halving year, so it could occur then. But last cycle, remember, we went up to this band in the early part of the post-halving year, right? So it's really hard to say. But anyway, this is your logarithmic regression analysis for Bitcoin. And remember, the pattern has always been the low occurs, the initial low from the bear market year occurs at the same level that the last bull market was built from. And the prior low of the last bull market in terms of the logarithmic regression low, not necessarily the price low, the lowest level on the logarithmic regression, that's where that first initial low occurred in the bear market year, right? You can see it every single time, right? This low here, same thing, was built from this regression band. This low here, that's where this one hit. I suspect that before we have enough juice to get a real bull market going, and not one of these fake ones, pathetic ones that everyone loses their mind over during the pre-halving year. But I think that we will visit this regression band. I think there's a good chance. And depending on when that occurs would dictate whether it's a lower low, a double bottom, or a higher low. If you want to say a double bottom, then that would mean occurring no later than February of 2024. So if it occurs by February 2024, or if it doesn't occur until February 2024, then it could correspond to a double bottom. If it occurs before then it could correspond to a lower low. If it occurs after then it could correspond to a higher low. It all depends on when it happens. And unfortunately, I cannot tell you that. I think the more important thing is to say, well, if and when it does happen, we should recognize the general trend. And historically, we get our first low that goes to one regression band. That was the same one from the last cycle. And then we normally get a secondary scare that goes to a lower regression band. Sometimes it's a double bottom. Sometimes it's a higher low. If it occurs soon, it could theoretically be a lower low. It all depends on when it occurs, okay, based on this model. Now, I could throw 10 other models at you that'll tell you something completely different. So when we talk about this stuff, this is not what Ben is saying or suggesting. This is what this model suggests. And remember, all models are wrong. Some are useful, which is convenient that some of them are useful, but they're all wrong. So just remember that. All models are wrong. Some are useful. I can show you 10 other models that are going to tell you 10 different things. But this one, that is what it suggests, that the secondary scare takes us to a lower regression band than the one we initially visit after the bear market year. And right now, that would correspond to near the 2019 high. If it occurs 6 months from now, it might correspond to a double bottom. If it occurs 9 months from now, it would probably correspond to a higher low. It all depends on when it occurs. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. See you guys next time.